Another interesting edition of the Market Review, and it's Friday. Thank God it's Friday, the 7th of August 2020, as we continue to give you the nexus between the financial and capital market as relates with the economy. First, let's give you an insight into what we'll be looking at today in terms of the Market Review. We'll give you an overview of the previous day market performance. We'll also bring to you the activation of the FGN savings bonds by the Debt Management Office. Nestle and other companies are turning in their reports and will bring you for second quarter 2020. And also some developments in the global markets as it also concerns frontier markets like Nigeria. Let's begin with the previous day market performance. Investors gained 25.19 billion naira. The NSE ASI inched up further by 0.19% amid negative market turnover. Equities market closed yesterday on a positive note as the NSE ASI appreciated by plus 0.19% to close at 24,930.34 basis points as against plus 0.16%. The appreciation recorded that previously. Its year-to-date returns currently stand at minus 7.12%. In terms of market breadth, the market breadth closed across board with Seplat leading 20 gainers as against 10 losers, topped by Union Bank of Nigeria at the end of yesterday's session. This showed an improved performance when compared with previous outlook. For the market turnover, it closed negative as volume moved down by minus 54.67% as against plus 148.14% uptick recorded in the previous session. FVN Holdings, WAPCO, and Japo Oil were the most active to boost market turnover. MTN Nigeria and Guarantee Trust Bank topped market value list. In terms of volumes, Presco led active stocks that recorded impressive volume spike at the end of yesterday's session. Let's get on to the bonds, fixed income, and money markets. The FGM bond market yesterday opened too wide, but better bidded across the curve. This is courtesy of Zcrest Capital. The auction papers say most of the market joy, especially on the 2026, which started at 7.90 or 6.50 at the early hours, but closed with most of its trade settling around 7% levels. At the tail of the curve, the 2035s and 2050s weren't left out, gaining few tractions as bids were able to match the offers successfully at mid-9% and 10% levels for most of the transactions that were sealed. As such, yields compressed across the curve by an average of 32 basis points compared to yesterday's level. For today, the expectation from Zcrest is that trading activities will remain at this pace as market participants continue to select only bonds offered slightly above the market. For Treasury bills, the OMO bill space stayed quiet as there was no major news to spur active market action. Zcrest saw few bids and offers at the tail of the curve, which was difficult to match as they stood widely apart. Some activity picked up as the session moved on, notably on 25th of May 2021 paper, which ended trading in the high of 4% range. And also, Zcrest noted a few interest in the August to September bills as offers hovered around 2.45% to 2.50% range for most of the trading session. However, yields compressed by 50 basis points across the OMO curve. A National Treasury bill space, the market calmness persisted, although they saw few retail demands for short-end bills, albeit no trades as offers stood at 1.4% level for December maturities. For today, the market is expected to remain calm with few order-driven requests on selected papers. In the money market space, with low funding pressures coming up and the interbank market remaining boosted with a fair amount of liquidity, Zcrest saw overnight buyback and overnight rates drop further yesterday, day on day, to close at 8% and 8.64% respectively. For today, the market is expected to experience an uptick in rates as funding pressure will remain low in the interbank market. At the Forex market level, the Naira traded on a solemn note in yesterday's trading session as the import and export FX window closed rates posted 0.96% gain in value to close at 385 naira 50 kobo per dollar amidst very low traded volumes. However, all other market segments remain unchanged, with the cash and transfer market closing the day at 472 naira to a dollar and 473 naira to a dollar respectively. At the Eurobond space, the Nigeria sovereign space saw the market rally yesterday slow across the bond papers, although with slightly better beats compared to the previous day at the belly and the tail of the curve. The 2038s and 2047s maturities were the major winners as yields dropped by minus 11 basis points and minus 0.05 basis points respectively. By and large, yields compressed slightly by the average of 4 basis points across the sovereign curve. The Nigeria corporate tickers, on the other hand, had a drab session, although yields stayed strengthened on most of the track papers except for the UBA 2022s, which closed on that level flat yesterday. And let's go on to Nestle Nigeria PLC, which posted its second quarter 2020 results, and analysis are coming on how Nestle has performed. Nestle's second quarter profit before tax was down minus 23% year-on-year on account of a gross margin contraction of minus 751 basis points year-on-year, reflective of an FX-induced inflationary environment. The company sources the majority of its raw materials locally, but the pass-through effect of the devaluation fueled an increase in local input prices. That said, the profit before tax beat the forecast by 21% on the back of a minus 10% lower than expected operation expenditure. A flattish sales growth year-on-year also suggested that despite the pandemic, Nestle fared better than competition. Case in point of the competition, looking at a minus 40% year-on-year sales decline from other competitors. Specifically, Nestle sales were supported by a 49% year-on-year increase in exports. This adjustment from the forecast showed a 2020 to 2022 estimate by an average of 3%. The forecast changes are, however, conservative relative to the profit before tax variance of 9% in the first half of the year, because the FX pressures on the operations and activities are likely to persist over the rest of the year. This adjustment and the rollover of the valuation to 2021 leads to a 7% increase in the price target of 1,636 kobo. Year-to-date, Nestle shares have shed minus 20% and underperformed the broad market index, which is down by minus 7%. The shares are trading on a 2020 estimate of price liquidity multiple of 23 times for average of earnings per share growth of 10% in the 2022 and 2022 estimates. At current levels, the price target for Nestle represents a potential upside of 39%. As such, the estimation retains that it will outperform ratings on the stock. That's for Nestle Nigeria PLC. The Debt Management Office has announced the resumption of its offer on the Federal Government of Nigeria savings bonds, effective August 2020. The DMO was constrained to suspend the monthly offers of the FGN savings bonds in April 2020 due to the restrictions on activities and movement as part of measures adopted by the federal government to curtail the spread of COVID-19. The general public is invited to look out for the adverts on offer for subscriptions in various newspapers and the DMO's website. The offer for subscription will open on Monday, August 10, 2020 and close on Friday, 14th of August 2020. Investors are encouraged to continue saving to the FGN savings bond as they attract good incomes and are secure, being a sovereign instrument, whilst also contributing to national development. Let's go global now. Shares on Wall Street shrugged off a sluggish start and closed higher yesterday, with the Nasdaq ending the session above 11,000 for the first time as investors hoped for a new fiscal stimulus package from the US government. Tech and tech-related heavyweight stocks such as Apple, which rose 3.49%, and Facebook up 6.49%, helped pace gains on indexes. The tech-heavy Nasdaq clinched a new record high in early trading and closed above the 11,000 mark for the first time after initially climbing above it on Wednesday. The benchmark S&P 500 and blue chip Dow were about 1% and 7% away from their own peaks scaled in February. Markets have been incredibly resilient. There is a big fear of missing out, and it is the old stalwarts, the technology leaders, that keep driving the market higher, said Sal Bruno, Chief Investment Officer at Index IQ in New York. Economic data released yesterday painted a mixed picture as the U.S. Labor Department numbers showed a first fall in jobless claims in 3 weeks, although a separate report showed a 54% surge in job cuts announced by employers in July. The data comes ahead of government payrolls reports, which is expected today. Investors are looking to the next fiscal aid package to further cope with the fallout from the COVID-19 pandemic. But Senate Majority Leader Mitch McConnell of the Republican Party said yesterday that both Republicans and the Democrats remained far apart over what to include in another wave of relief, which calls for bipartisanship in these times. At the global commodity space, gold extended its record-breaking run yesterday, driven by expectations of more monetary response as surging virus cases continue to pummel the U.S. economy. Gold has rallied more than 35% this year as it is considered an asset that should hold its value while the pandemic and money printing by central banks erode the value of others. Markets awaited further policy response as the U.S. Democratic leaders and White House officials continue their talks to try and address the new wave of relief to help the economy recover effectively from the adverse impact of COVID-19. That's looking at the global commodities market and its response to policy statements and positions. Let's go to Europe, where the equities market declined yesterday as London stocks were sapped after Glencore scrapped its dividend and oil stocks slid. Investors kept a close eye on Washington for progress on the U.S. stimulus. The pan-European stocks 600 index closed 0.7% lower, with the London FTSE 100 falling 1.3% and the German DAX down by 0.5%. Europe's mining index SXPP, which rallied earlier this week, shared 2.5% after Glencore became the first major mining company to scrap its dividend and said that it would by prioritizing cutting its debt. Its shares slumped 8.1%, while energy majors BP Royal, that's British Petroleum Royal Shell, and Total fell between 2% and 3.8% after strong gains on Wednesday. Wall Street indexes were largely flat, stalling near record levels as the U.S. Democrats and White House officials struggled to work out a stimulus package for the coronavirus pandemic-stricken economy. And still on the global European shares dipped yesterday as forecasts of a slower post-pandemic economic rebound in the UK hit London stock markets. The disappointing quarterly updates from Glencore and AXA weighed on broader sentiment. The pan-European stock 600 index slipped 0.4% by 0710 GMT, with London's FTSE falling 1.1%. The more intentionally focused UK stocks took a hit as sterling rose after the Bank of England kept rates unchanged and warned of possible risk from taking interest rates below zero. Again, mining group Glencore dropped 4.3% after it decided to scrap its dividend to focus on lowering debt, as COVID-19 pandemic forced it to book a $3.2 billion impairment charge. That's a really massive impairment charge for Glencore. Yesterday, Intercontinental Exchange Incorporated said it would buy Ellie Mae, a cloud-based platform provider for the mortgage finance industry, from private equity investments, Thoma Bravo, in a deal valued at $11 billion. Huge, huge deal. The deal comes at a time when the owner of the New York Stock Exchange is strengthening its focus on mortgage services, just to give you some insights into how activities are going on in the market. So we could see that Glencore, the decision by Glencore, a major mining company in Europe, global player, to cut dividend, to scrap dividend and focus on lowering its debts and achieve sustainability, had its impact on the European markets especially. And these are steps and actions that continue to shape market activities. Through the week, this week has been very eventful with the announcement of the Q2 2020 results of major oil companies like ExxonMobil, Chevron, and even the major oil firms, and British Petroleum also. This report showed that they recorded losses, and this has also impacted the markets and showing you how the oil and gas market, the whole commodity space, is continuing to experience challenges this period. But gold has shown this week some resilience and some prospects, but this is still a wait call as monetary policy actions will continue to shape the direction. And as you've heard, Mr. Andrew Berry, the Bank of England governor, left rates unchanged, maintaining a dovish step for the UK. Also this week, we've seen that there's so much anticipation around the next level of the US fiscal stimulus, because it's very critical for the jobless claims. America has millions of unemployment claims, and also businesses in America are also looking at how they will get additional support to operate and carry on their activities. Don't forget that America is also grappling with these high unemployment rates, the first in history since the global economic depression, and also its first structural economic crisis post-2009 global economic recession. And so the activities, the negotiations between the White House and Democrat House leaders, Chuck Schumer from the Senate and the House Speaker, Nancy Pelosi, remains very critical at this time, and the decisions from there will continue to have an impact on global markets direction and activities. Don't forget that Europe actually had a breakthrough several weeks ago in terms of the recovery plan. Over 750 billion euro was agreed by European leaders in terms of supporting the various countries to navigate the pandemic effect, and that has its positive effect on the economy. But if the US will be able to agree on the pathway to the next level of relief plan for the economy, that remains a big issue to monitor. So are we going to see a bipartisan approach? That's between the majority Republican leader, Mitch McConnell, and Chuck Schumer from the Democrat part. That will be very important, part of our monitoring, even as we enter into the new week. And we've seen already that the Debt Management Office has issued the fact that the FGN savings bonds, Nigerians can access it, but that's between Monday next week, 10th to 14th. And so this is to all Nigerians to take note of that. It's very important that we continue to explore how we can invest in savings instruments in this period. It has also been a very eventful week in terms of the decisions around policy strategy and how it will impact the markets. Like I said yesterday, Nigeria also needs to explore how it can leverage the markets to attract more tech firms. We can see now that the NASDAQ continues to drive and achieved over 11,000 points mark. And this is driven by Apple and Facebook. So we need to create an enabler for tech companies to come on board and really leverage the markets to drive their activities. The fintech industry is a promising industry in Nigeria, attracting a lot of investments. Like I said yesterday, I attracted over $300 million investment last year, and see has that prospect, despite the pandemic, to attract over $150 million investment. Saying that, it shows that we need to capitalize on the opportunities of the tech industry to push and drive a robust market. From what we've seen in the mining space, there are prospects that if the PAGMI, that's the Presidential Artisanal Gold Mining Initiative, is strengthened and moves as planned, we in Nigeria will begin to see the benefits of diversification in revenue as we begin to see deeper activities in mining. That is one big opportunity. It's a big gold mine. Of course, it's a gold mine is a huge revenue source for South Africa. So Nigeria can come to that level where we begin to look at solid minerals of commercial value becoming key drivers of economies. And I reemphasize the need for a negotiation at the federal level with states, where we can restructure our fiscal composition That fiscal composition will see states having more access to determining how their resources are tapped and utilized for their benefits. Currently, the mining rights is more exclusive and is on the concurrent list, and that is an inhibition to states being able to lay claim and gain value from issues and activities like mining, because currently the structure doesn't help that productivity. Dependence on the federal allocation accounts, FAC, is not also helping states. States are going through a lot of challenges this period. So we want to re-emphasize the need for a fiscal restructuring process where states can have more access to determine how they can drive their revenue base, diversify it with areas like the solid minerals. Still talking about tech, the roadmap for fintech has been rolled out by the Securities and Exchange Commission. So we expect the current administration in SEC to take it to the next level, to deepen the activities there, create that consistency and clarity in terms of supporting the activities of fintechs and other tech companies who would really want to assess the market. Also, Nigeria Stock Exchange in the week rolled out its guidelines for collaborations for its dealing members when it has to do with fintech collaborations. That again is another welcome development which needs to be explored and leveraged to improve the activities and engagement and interactions with the fintech community. We're seeing a lot of tech-driven activities and the markets evolving to become more tech-led, and that calls for investment in cybersecurity. Yes, cybersecurity will be very important in this time to ensure that trades, activities, and market operations are securitized, are well covered and captured to ensure that we don't experience any incidents. We know that the incidence of hacking is there, but cybersecurity gives that guarantee that we're able to ensure and protect the interest of companies, sensitive information from being accessed by hackers. So cybersecurity remains one area that will need robust investment in the capital market ecosystem, considering the fact that this is a sensitive market and that activities in the market are very vital. We've seen also the turning in of results, second quarter results. Oil and gas sector is being hit seriously, like aviation. We're seeing prospects among the agro-based companies showing some positive strides, alongside health companies showing some positive strides, banking groups, relatively fair performance, and we expect that in Q3 2020, those results will come in and show a big level of challenges in terms of the operations and the impact of the pandemic. But it also brings to the fore the need for more innovation. We also commend quoted companies who are continuing to open up the space for interaction with the markets, engaging stakeholders, creating the opportunity for stakeholders to engage and know what is happening. Don't forget that Guinness remains one company that issued a profit warning on its activities despite the pandemic, and that is commendable. We expect to see more companies come on board and create more information, provide more insight into their operations. Like SEC had issued during the pandemic initial lockdown, that every capital market operator should engage the market and declare the state of activities as it concerns the pandemic and how it's affecting their operations. We expect that all market players will do so to help the market move forward, because information is critical and transparency is key for a vibrant and dynamic and progressive market, which we all want to ensure that investors can create value, derive value. Don't forget that part of the reasons why the market has continued to struggle and go through its challenges is because of the challenge of transparency and the issues of accountability. And don't forget, 2008, 2009, retail investors lost a lot, and that has been at the front burner of every administration of SEC Nigeria to bring back their confidence, bring them back on board, let them engage the market. So we hope to see that transparency will continue to be driven in the market, technology will be leveraged to achieve that, and we'll see more information where required on how capital market operators and quoted companies are operating, especially through this pandemic. It's very key for investor confidence. And that will be all for the market review this week. It has been a very eventful week, looking at market activities, discussing it, and how it's impacting the economy. We always, in this program, give you reports or analysis and also exclusive interviews just for you to know on the capital market, financial market, as it relates to the economy. But log on to our website, www.proexchange.com, to watch our videos through the week and our reports and analysis on our analyst and markets. Also, for all our investors and the public this period, we want to implore you to beware of online platforms that promise you 100 to 200% returns. Most of these platforms are not registered or regulated by the Securities and Exchange Commission. You must insist to check if they are registered or regulated. You must make your background search, because you can't take all your savings, your hard-earned money, to put into schemes that are not credible. Because over the years, Nigeria has had a history of Ponzi schemes that's ripped off people of their entire savings. We don't want you to be a victim. We want you to learn from history and also take action and precautionary steps. That will be all for this edition. Thank you for watching. Have a lovely weekend ahead. Have a nice day and stay safe.